watching us on us, so all we have. Just turn it on right here. Mute it if you need to mute it.
Okay, might as well. Good morning. The Insurance Committee of the Tennessee House of Representatives of the 113th General Assembly is now in session. Today is Tuesday, February 6th, 2024, and the time is 10:35. Madam Clerk, please call the roll. Wait, is it Mr. Clerk?
Representatives Sapicki, Davis, Freeman, Helton Haynes, Hemmer, Hicks of Hawkins, Hill, Johnson of Montgomery, Johnson of Knox, Lafferty, Mitchell, Ritchie, Rudd, Rudder, Sparks, Terry, Thompson, Vice Chairman Martin of Carroll, Chairman Kumar.
Here.
Mr. Chairman, you have a quorum.
Thank you. Members, do you have any personal orders? Chairman Lafferty, did you want to report on the weather?
Thank you, Mr. Chairman. Sunny and warmish. Who could ask for a better day in February? Thank you, Mr. Chairman.
Thank you. Just a reminder, and I will do that frequently over the next few weeks. NCOIL, the National Conference of Insurance Legislators, is a national organization that deals with insurance legislation and provide education to the legislators. I have attended their meetings, and they have model legislation on various matters, and it was a very productive effort. They are coming to Nashville April 11th through the 14th. The meeting will be at the Sheraton. We will send you frequent reminders. They would like us to come and be a part of their meeting. Seeing no other personal orders, we do have two presentations today. I want to thank the presenters for coming. I have asked Chairman Powers for the last few years to teach us a little bit more about insurance, and he has agreed. And Mr. Ben Sanders is one of our own insurance activists. And these are very knowledgeable people, and I learn a lot from them, and I'm grateful for them coming. The first presentation is we'll let and recognize Chairman Powers to get started. We will go out of session.
Thank you, Mr. Chairman, committee. I didn't know how to work this microphone up here. But I want to say thank you. I've been serving the legislature since 2010, and I've been on the insurance, and it was the old Insurance and Commerce Committee, and then they changed it to the Insurance Committee, and I've been serving up until last year when Dr. Kumar kicked me off the committee. And so I'm glad to be back, though. I see a lot of colleagues on here and a lot of friends, and I really appreciate this opportunity. I know during my 12 years on the committee, we didn't talk a whole lot about property and casualty and the rates or anything like that. So we wanted to kind of briefly go over that with you today. I'm getting a lot of calls. I already had one this morning, but property and casualty insurance, the rates are really going up on commercial insurance too. So we want to go back over about how the rates are actually go through, how they're approved, what causes a rate increase for an individual or for a company overall. So we're going to talk about that. I've seen commercial rates. I've been an insurance agent for 35 years. I was with Allstate for 21, and now with Nationwide for 14. So I get a lot of calls, and like I said, I've already had one today. But we've seen commercial rates, especially over the last couple of years, go up from 20 to 50%. Had one that went up 100% the other day. So we're going to talk about what causes that. And one of the main calls I get, and I'm sure you all probably get this too, is, but I get it every day. If I've not had a claim, why is my rate going up? So we're going to talk about a little bit about that. Why are my rates going up, even though we've not had any kind of claims? Talk about the whole spread risk, the pool aspect of insurance companies, and why, if you're with a company and they're having more claims, and even though you haven't had one, how it can affect your actual rates too. So many different things go into that. The car values continue to rise, as you know, if you've bought a car recently or tried to. Uh, Homeowners going up to the cost of homes, the cost of replacement parts and labor, even on a vehicle, and the roofs. I mean, that's probably our number one claim when we start dealing with homeowners are roof claims. And so many times we have a roof claim, and the contractor, they'll hire a contractor to go out and look at it and say, hey, your roof has got hail damage. Well, that's because they don't want to repair the roof. They want to replace the roof. And so then we have to go out and say, hey, we can replace it or repair it or whatever in a particular area. But they're in the roofing business. So a lot of times we run into that from time to time, but the adjuster has to make that final call. One thing we deal with a lot too, and you'll hear stories about all these different catastrophes, what we call them cat claims, but whether it's a tornado, hurricane, or whatever, and how much more damage it's doing than it did 20, 30, 40 years ago. Well, what they don't take into consideration and what they don't tell you, a lot more populated area, a lot more denser populated homes, or, if a tornado hit something 30 years ago, it might have wiped out 5 houses, and that might wipe out 50, because of the density of the homes and the population. So that's not a good relative way to talk about catastrophe claims, just the amount of dollars only, because when you look at that, you think, well, the world's coming to an end. We're getting all these damages, all these claims are going up. Of course they are. We got more homes, got more expensive homes. We got them in a condensed area. So floods and hurricanes, we've always had them, always will. And as the population will increase, so do the losses that we have. So with that, I would like to turn it over to Mr. Robert Gordon, and you just introduce yourself and tell them who you're with, Robert.
Thank you so much. It's a pleasure to be here today, especially after I figured out how to work my mic as well. I'm Robert Gordon, and I'm the Senior Vice President for the Policy Research and International Division for APCIA, and that's the American Property Casualty Insurance Association. We're the primary home, auto, and business insurance trade association. So insurers' core business is protecting people and helping them recover from catastrophic losses. And I'd really like to be here today to tell you that our insurance industry is extremely strong and stable and profitable, but I can't. Ratings agency AM Best last year downgraded the entire homeowners insurance industry from stable to negative. So they're downgrading our industry because of all the losses. In fact, the number of downgrades of homeowners and car insurers in the first half of last year more than doubled. So companies are pulling back, going out of business. APCIA reports on a regular basis the financial operating results for our industry. And in 2022, insurance capital plummeted more than $73 billion. That's a hole even the good governor of this state would find challenging. Insurers' net underwriting losses were the worst in over a decade. And for the first half of 2023, for every dollar that the insurance industry collected in premiums, they paid out $1.043 in claims and expenses. So they're paying out more than they're taking in, and that's continuing a trend of underwriting losses. For all of 2023, and we don't have all the final reports in yet, but rating agency S&P predicts auto insurers are going to have an 8.7% net underwriting loss, and homeowners insurers are expected to have a 12.1 underwriting loss, the worst in over a decade. So the challenge here is very simple supply and demand economics. Insured costs and exposures are rapidly escalating, and those are going up much faster than insurers have been allowed to raise rates in many states. An industry that's losing money is not going to be able to attract new investment capital. And so as a consequence, as our economy grows, and particularly states like Tennessee are booming, there's not enough insurance capital to cover consumers' increased coverage need. So let's look at some of the data together. So this graph shows that insured natural catastrophe losses have been rapidly growing, roughly doubling over the last 5 years. Huge increase in these disaster costs. This is for Tennessee specifically. You can see Tennessee suffered record disaster losses last year, and the green bar shows the record number of severe storms. So Tennessee is not at all an outlier here, a very significant increase in losses. Now, there's a lot of false narratives out there about what's causing the losses. So people are trying to point fingers and say, well, it's all climate change or it's all those greedy businesses. But as you deal with the hard data, it's actually very clear what's going on. And in particular, there are a number of studies from domestic and international analytic firms that demonstrate the top cause of increased insured losses and the corresponding rate increase. It's the rise in exposure values and replacement costs. So in essence, people moving to Tennessee, they're building more expensive homes, they're building out their current homes, living in nicer places. And the record inflation is making those homes a heck of a lot more expensive to repair than it used to be. So that has increased the demand for insurance at a much faster rate than the rates have increased. We also have the shifting weather patterns, legal costs, regulatory costs. Those are all contributing, but those are really secondary factors to the demographic shifts and the inflationary increases. So the left graph here shows the spike in replacement cost of structures nationwide, and the right graph shows for Tennessee in particular, and this is from the Federal Reserve Board. Look at how much the increase in housing prices for Tennessee has been. I mean, you're probably all more familiar with this than I am, but you can see it's a huge increase in these home values. And that's what's causing the rate increases is people are moving into the nicer homes. They're building their current homes out. A lot of that's in areas impacted by tornadoes and floods and windstorms. The average insurance rates are now trying to adjust to a housing stock that has become more than 40% more expensive to rebuild over the last 5 years. This graph talks about inflation. So we're all suffering the cost of inflation. So, consumers have to worry about increasing energy costs, food costs, shelter. Every time you go to the grocery store, your bills are getting higher and higher. Same thing for insurance companies. Our cost inputs are going higher and higher, and they're increasing on a cumulative basis faster than our rates are going up. So this graph tracks cumulative inflation and the specific input costs for insurance. The left one is home value input costs, and the right one is for auto. You can see on the left graph, homeowners' values and construction costs, those have increased significantly more than homeowners' insurance rates using Bureau of Labor Statistic Producer Price Index data. Right graph shows that the cost inputs for auto insurance, things like auto parts, new and used cars, those have also increased faster than the Producer Price Index for auto insurance. I did mention there are some other factors like the increasing legal costs. You can see on the left side the sum of corporate nuclear verdicts, the right side is the corporate legal spending. Those are all increasing. There was a dip during the pandemic, but those legal costs are now going up. And regulatory burdens are increasing in most states. Now, I have to acknowledge Tennessee is one of the much better states in the country. It's more efficient. You're not seeing the enormously long delays that you have in some of the states like California. But where insurance always has a little bit of a lag time in recognizing inflation, putting it into your rate filings, filing it with the department. So we're always playing catch up. And in those states that have tried to suppress rates like California and Louisiana and previously Florida, they've caused massive pullbacks in the marketplace. So California right now is dealing with a crisis where a majority of the top insurers have been pulling back from that market. Tennessee insurance markets have been fairly stable, but all those people moving into more expensive homes in Nashville and Knoxville and all the recent thunderstorms, tornadoes, ice storms, those have all caused homeowners insured losses in Tennessee to increase 80% over the last few years compared to a 27% nationwide increase. Let me just repeat that, 80% increase. That's nearly 3 times the national average for homeowners losses in Tennessee. That's what's putting the pressure on the supply and demand. Auto losses temporarily dipped during the first half of the pandemic, but you can see by 2021 they'd normalized, and by 2022 and 23 both nationwide and in Tennessee, those losses are escalating. It's really more expensive cars. So if you look at the average price of new cars, it's way up, and cars now have all this great technology, all these sensors built in around the cars, which helps you, in theory, avoid accidents. But what's happening is every time you do get into a crash, it's really expensive to repair. It means you have to recalibrate all of the sensors. You need more specialized shops. There's longer delays. They have a harder time getting labor. So great technology, but it's costing a heck of a lot more to repair and replace those cars. And for whatever reason, people are doing a lot more distracted and drug driving. So that's also contributing. And then even in Tennessee locally, when you have severe ice storms and hail, that also escalates some of those losses. So I also want to address the ubiquitous false narratives about property casualty insurance company profitability. So this left graph, you look at the orange line, that's the home, auto, and business insurance profitability. That data comes from the NAIC, the state regulators. Look how much lower that is as you compare it to the green line of all commercial sector profitability. You can see there's a big gap that is growing in the profitability. It's not a highly profitable industry. And in fact, you look at the right graph, our capital in our industry actually contracted at the same time GDP was growing. So there's more and more demand for insurance coverage, but less capital to cover all of those needs. And again, that's what's creating a lot of the friction right now. Insurance demand is increasing, more expensive cars, homes, inflation, weather losses, insurance supply decreasing because the losses are increasing faster than the rates, and the profitability isn't high enough to attract a lot of new capital. New capital is finding much better alternatives than insurance. So that growing mismatch between demand and supply for insurance capital, that's why the credit rating agencies, AM Best and S&P, downgraded the personal lines sectors, and that's why there's been an availability crisis in states like California that have tried to suppress rates so that insurers have had to pull back from the markets. We're not going to be able to stabilize this. You look historically, particularly at times when inflation rises, insurers are always playing catch up when inflation spikes. And until insurers close the gap between losses and rates, it's always going to be a challenge to stabilize those markets. There are some long-term solutions we are promoting. Insurers are very active in developing car and home safety standards that not only save lives, but also increase resiliency. The latest, I think, very exciting developments are on the wildfire side, which Tennessee is also subject to. And the insurance industry has recently developed community wildfire safety standards. And we're very active at the state and federal level trying to encourage adoption of those standards to protect communities and make homeowners insurance more available and affordable. So a lot going on in our industry. Your guidance and any questions. And with that, I will turn it over to my colleague.
Thank you, Mr. Gordon.
Oh, questions now? Oh, okay.
Yeah, we are going to take a break and see if our members have some burning questions in their mind that you generated. One thing that stands out was an article, I guess it's the 26th of January in the Wall Street Journal, that basically said that insurer profits soar as rates climb. That's a little different from what you're saying, but I think they are showing a segment of the insurance industry. They are Travelers, Progressive, as well as Allstate. The stock was up 40 to 50%. They had double-digit increases. And I think there have been increased losses, no doubt. We've seen the major events that have occurred. But the picture painted there was that overall, the profits are up. And would you like to comment on that?
Yeah, happy to. Great question. And we've actually now been talking subsequently to the Wall Street Journal reporter that wrote that article. So if you look at the stock changes for our property casualty insurance sector, you'll see that it actually increased much less than the S&P and the NASDAQ. So yes, the markets are going up. That does help some of the stock companies, but it's actually increased less than the overall marketplace. The other thing is some of those individual companies are heavily into commercial lines. And so the commercial lines suffered the same challenges of the personal lines, but the commercial lines caught up more quickly because you don't have the same rate suppression or rate delays that you do on the homeowners and the auto side. So those companies, the commercial markets have largely stabilized. The good news is you're not seeing the significant increases in the commercial market right now because they caught up, so they don't need to close the gap. But on the personal lines, if you look overall at the industry, significant losses. The expectation that most of these companies have been reporting in their earnings results over the last few weeks is that it'll take until 2025 before particularly the homeowners line catches up and closes the gap. Auto, they're hoping to catch up by the end of this year, so either this year or next year, but it's still closing the gap. And again, if you look at the profitability numbers reported by the state regulators, you'll see they're much, much lower than any of the other sectors.
Thank you. I think you're right. There is a there's a segment of the commercial industry that seems to be the focus of this article, and that's what they were referring to. One thing also noticed was that during the COVID pandemic, people drove less, so auto accidents were less in numbers and fewer car crashes. And as we come out of it, the economy begins to boom, there will be an increase. Is there an increase in motor vehicle accidents?
Yes, and in fact, something that isn't very often talked about in the media, but even during the pandemic, people drove less, but you saw traffic deaths rising to an all-time high. So the severity of the accidents continued to increase significantly, offsetting much of the reduced frequency. If you look at the left graph here again, you'll see that in fact there was an improvement in the losses versus premiums in 2020, but it had normalized within a year, particularly because of the increasing severity. And now it's the losses are far, far above the historical averages. So there was a brief reduction, but the losses now have essentially swamped that temporary improvement.
Your motor vehicle accidents are up, and you mentioned distracted driving, but it also appears there's a recent article a couple of days ago about THC playing a role, more prevalent use, and that leading to the effects seem to last longer than alcohol and increasing driving on DUI type of accidents and so on.
Yeah, that's a really important point because APCIA never took a position on the legalization of marijuana, but we've always said that states need to have standards if they go that route. And consumers need to know if you smoke marijuana, at what point is it safe for you to drive again? And unlike alcohol, the measurements for marijuana, the different kinds of marijuana weeds have very different potencies. And so as a consumer, you don't know how potent it's going to be very easily, and you don't know how long it's going to be in your system. And the science on that is still evolving. And so that's been an enormous challenge, as you pointed out, that you have a lot of consumers who think it's safe to drive because it's been 2 hours, but in fact, we're now seeing that it lasts much longer in your system. And it may depend on an individual, how much tolerance you've built up, how long that effect is going to last. So it's a lot longer than people think, and that's a significant contributor to the accidents.
You're right. The guidance and education is not there, but rather than spend resources on guidance about when is it safe to drive, it'll be better not to use the thing.
May I make a comment, Mr. Chairman?
Please.
Okay. I just want to mention, and it doesn't affect our state as much, but it affects the overall company profit. Carjackings have gone up, thefts have gone up. So that's another thing that affects the profits of a company. And we see in our state a lot. I know when I drive down here, I got about a 3.5 hour drive. But even though we have a law that says the cell phone, you're not supposed to be using your cell phone, or you're supposed to be using Bluetooth if you are. But half of the people I drive by, they're looking down at their cell phone and they're driving all over the road. And I know it's very hard to police that or patrol that. And I know we have a law against it, but it's really causing I've seen a lot of accidents, even on my way home and down here, simply because of that somebody had the cell phone usage. So
We have a company that we work with that tracks how people use their iPhones or Androids while they're driving. And some of the things you'd expect, like Google Maps, people are watching Netflix and Amazon Prime and looking things up on Google while they're driving. I mean, it's just incredible. And the expectation of particularly younger people in society that you're going to respond immediately to a text, it is a huge growing problem now. Distracted driving.
Well, thank you. Members, kindly, Representative Freeman, you're recognized.
Thank you, Mr. Chairman. Thank you. So I want to talk a little bit about more commercial lines. We've seen in the past 5 years, 6 years, the increase in specifically multifamily insurance rates, double, triple, quadruple, to the point that, when 4 or 5 years ago, it wasn't uncommon to see rates of $350 or so a unit, and we're now above $2,000. And there are many carriers that won't even write a policy, or it's a giant. I mean, the premiums are giant, but the deductible before you meet it's in many instances $1 million. Here locally and across our state, we have a real issue with affordable housing, and those costs directly translate to increased rents. And the Apartment Association put out not too long ago, and speaking of profits, where every dollar of rent goes, and it used to be in the 1 or 2 cents on insurance, and it's now 15 cents. We're closely and fast getting to a point where it's not a manageable problem for the insurance industry to expect a company to have $1 million deductible. I mean, they're effectively self-insuring except for a catastrophic loss. And then your industry has increased the valuation of the property and how much insurance you need to take. It used to be 60%. Now they're asking for, 85 or 90% of the replacement value. What's the solution? Because we're going to quickly get to a point where people just can't afford it. I mean, already in coastal areas, you talked about California multiple times. It's not just that they've capped the rates; it's that they're having so many catastrophic storm and weather events that insurance companies are just not playing. I mean, I know people are going to look at captives, but that's not the best solution. So I've said a lot, but I'd love to hear and know you guys are trying to solve this problem.
Yeah, great question. And that is something we are spending a lot of time trying to address. I mentioned earlier, trying to explain some of the reasons for the increase in property insurance. You've got 40-year record inflation. You have much more expensive buildings generally. As I mentioned, in Tennessee in particular, you can see the property losses have really skyrocketed even compared to the rest of the nation, all of the increased tornado activity and so forth. One other thing I'll mention that is a little unusual is, one event or a couple of events around the country don't usually impact everything else, but the Surfside condo collapse in Florida actually did suddenly make insurers and builders realize that if you don't have adequate maintenance on some of these commercial buildings, that can greatly increase the losses. And so now there's a renewed emphasis on trying to specifically underwrite the building and see what kind of maintenance has been done and is there enough money being collected to do that maintenance. So that's been a little bit of a shift. I think I mentioned as a longer term solution, it's really going to require a lot of mitigation resiliency. So better building codes, better community wildfire safety standards. Those will all help. But at the end of the day, a lot of it's going to be inflation. So, we've got to keep inflation down, let the rates catch up, and then there's going to be more coverage.
Representative Freeman?
Can I add to that, please, Mr.
Please.
Chairman? One thing that I run into a lot too are liability claims. So when people are getting hurt on apartment buildings or whatever, the first thing, everybody's most of the time are required to carry their own insurance. for their own apartment and their liability with that. But if they get hurt in a hallway or on a stairway or something like that, we've seen that dramatically go up too, the number of lawsuits and everything. And that causes a rate increase too on the multifamily homes.
Go
But,
ahead.
yeah, and again, I appreciate your reasons for it. But this is a warning. It's quickly becoming unaffordable, and it's directly affecting affordability in multifamily housing. And we're hearing we're going to see another doubling of rates and potentially an increase in deductibles. And building codes are not going to solve it. There's going to have to be a meeting in the middle. So thank you.
I guess with increasing losses and increasing expense to rebuild those places, it is natural that the costs are going to be higher and higher. The industry is fairly open as far as the profitability and what happens there, and insurance rates are approved by the states individually. But we will see what the solution is. But I think the concerns that the rates are going to be increasing again in significant way to become unaffordable to many people, that is a genuine concern. You mentioned that code improvements are not the answer. Who does that? Is that by regulation, or does the insurance industry play a role in it?
So the insurance industry is funding most of the research. So there's the IIHS, Insurance Institute for Highway Safety, that's funded all the crash testing you hear about. This car has a 5-star rating. That's funded by the insurance industry. The IBHS, Insurance Business Home, I'm actually forgetting the acronym now, but they have the wind tunnels where they show how wind impacts property structures. And as I mentioned, most of the really exciting research they've been doing lately is on fire safety standards. Fire safety standards are a little harder than the wind, because the wind exposures, you can make your own individual home more resilient. For fires, it really has to be more of a community standard, because even if your house is made fairly safe, if all of your neighbors have a lot of brush right around the house that can easily catch on fire, then your house is still at risk. So the insurance industry has funded most of the research into improving safety standards, but it's really primarily the state governments that actually adopt those standards and implement it. I think where we've seen a real sea change is we used to get more opposition from some of the builders and realtor groups because some of these safety standards will have an increase on costs of buildings. But I think now they've very much come around and realized that to make these affordable in the long term, you've got to have adequate building safety for these natural perils. So they're becoming much more supportive of adopting those.
Representative Hemmer, you're recognized.
Thank you, Mr. Chairman. A question, because the chairman brought up an item about crime. Just curious, Tennessee has more thefts of firearms and cars than any other state in the country, and I was curious about how that would affect the underwriting of our home insurance and the rates, and how the industry takes that into account.
Yes, that is both on the personal line side and on the commercial side. So we've seen, for example, a lot of particularly certain kinds of cars that are easier to break into or easier to cut off the catalytic converter. The rates have gone up for those cars significantly. We've also seen for commercial buildings, as the pandemic accelerated the trend of people working remotely, and suddenly you have empty buildings. Well, empty buildings have a much higher likelihood of a leak that turns into a flood or criminal activity in those empty buildings. And so that's raising some of the commercial property rates as well. So the theft and crime is a significant issue, and it is part of one of the cost drivers.
Yes, follow up.
Thank you, Mr. Chairman. Also, you mentioned California and some the weather affecting issues around that. And I've seen lots of stories about Florida this past year and the issues they've had with the storms and the increasing severity of those storms, is like, for instance, we're seeing today in California on the news. But so I was just curious about how the industry looks at climate change and the effects that it's having in our areas, and how that's affecting underwriting as well.
Yeah, so we know that globally the insured losses from weather have been increasing 5 to 7% a year, so very significant increases. But only a portion of that is climate change. The larger impact really has been inflation right now. So inflation is really the top cost driver, along with all the people moving to this wonderful state of Tennessee and buying more expensive homes that cost more to rebuild. I didn't include a slide. My staff had me strip it out, but interesting with climate change, enough insurance studies have been done that shows it impacts some perils more than others. So, for example, it seems to have a greater impact on droughts and floods, less of an impact on some of the severe convective storms, the tornadoes and the like that have been prevalent in Tennessee. So I think some of the insurers feel it does have an impact, but very secondary right now to the inflation and the demographic shifts.
Fine. Well, Chairman Lafferty, you recognize.
Thank you. And it is getting warmer outside. Sorry, that was bad. Thank you, Chairman. I was curious. I've heard that with the growth in the electric vehicle market, manufacturers of those vehicles, if they also produce gas-powered vehicles, they are having to charge more for the gas-powered vehicles to subsidize the electric vehicles. I don't know that that would add to the cost to repair a gas-powered vehicle, but I'm curious, are there comparisons in the average cost to repair, say a typical four-door sedan that is gas-powered versus electric-powered? Do the electric vehicles cost more to repair? Do they cost less to repair? How does that shake out? And as that grows, how's that going to affect you guys over time?
Great question, and such a great question. I actually had one of my team members, I asked him to do a white paper on that. So we'll send you our white paper, but the short answer is they are more expensive. They're a lot more expensive to repair. Part of it is all the sophisticated technology. Interesting, they're also more drivers are more likely to get into accidents in their first year of driving, because sometimes it's driven in a slightly different way than a gas power car. So longer term, not so much, but in that initial transitionary period, we've seen a few more accidents. They're heavier. So, for example, a recent study that was done showed that some of the guardrails around the roads aren't designed for the kind of weight of the impact of these cars. And of course, if you have a heavier car, it's going to cause more of an impact. So there are some knock-on effects, and we have a whole paper analyzing that. Happy to provide to you.
Okay, follow up.
And as a follow-up, you're an insurance company. You don't care which vehicle gets damaged, but you have to spread that risk across both drivers or both purchasers of insurance. We talked a little bit about people pulling out of markets in California, I guess coastal areas that more difficult to insure homes. Is there any concern that people have a hard time getting coverage for electric vehicles down the road, or?
I think the insurance industry in the long run's always been able to adjust. Where if you look historically at where there's been real friction in the marketplace, it's one of two things. It's either when inflation spikes, and then just because of the lag time, like a grocery store can change its prices every day. An insurance company typically takes a year to model it, file it, get it approved, and then you have to wait for 12-month policies to roll over before you can put it in. So it's when inflation spikes, it's hard, or if there's a sudden recalibration in the assessment of risk. So like cyber risk, really hard to estimate. A couple of years ago, the losses were sky high for cyber attacks. Now the industry stabilized. We have a better sense of the risks. When Hurricane Katrina hit and Hurricane Andrew, those caused the industry to reassess the hurricane risk. But generally, I think we've got a fairly good handle as an industry on some of the autos, and it's evolving at a pace the industry can largely adjust.
Thank you for that. Thank you, Chairman.
Thank you. Just out of curiosity, how many people drive an electric vehicle? Okay, one. All right. Yep. We'll go on to our next presentation. Mr. Sanders, you recognize. We are still awake.
Thank you, Mr. Chairman. I'm Benjamin Sanders, Farm Bureau Insurance of Tennessee. A few more questions and you would not have time for your local insurance activist. I'm going to attempt to switch this over, Mr. Chairman. There we go. Thank you for the opportunity to be here, Chairman Kumar and members. If I may, I'd like to take a moment of privilege and read from testimony that has previously been submitted to the General Assembly of Tennessee, and I'll explain in a moment why I'm doing this. I will spare you the 20 pages, and I'm reading some excerpts from this. We conduct statistical studies of the income and loss experience of the insurance company. We give special attention given to such matters as premiums earned, losses incurred, loss adjustment expenses, taxes paid, investment income acquisition expenses, and other administrative costs. Each item of income expense becomes very important in an industry where competition is so great. The ability to find ways of cutting cost without sacrificing service is a never-ending challenge. This has become quite a task because it seems that the never-ending increase in the cost of doctors' bills, hospital bills, and other medical expenses is exceeded only by a much more rapid increase in the cost of repairing automobiles. I feel it's appropriate to point out to the public that an insurance company is in the business of agreeing to pay the cost of services that are to be performed at a future date. It should also be borne in mind that the insurer has no control over the time, locality, and conditions under which it will be required to meet its contractual obligations. Increases are appropriate in a period of increasing inflationary situations such as we have been experiencing lately. Mr. Chairman, that was testimony submitted to this body by one of my predecessors, Mr. Buford Dredden, February 12th, 1979. Almost 45 years to the day ago, they were talking about inflation and cost of increases. The reason I bring that up is to show that some things are perennial challenges. And the second reason I bring it up is because it makes me very proud of the insurance industry. 45 years ago, we were talking about rate increases. And while it's not great that we still are, it means that insurance is still a viable product and people can still afford it and people are still purchasing it. And that makes me proud to be with this industry.
That is well put.
Thank you, sir. Today, I'm going to briefly talk about two areas in the insurance industry, specifically in the property casualty industry, and that's rate making and underwriting. Now, I have one disclaimer to start with, and that is this is a very high-level conceptual overview. Rate making and underwriting are very intricate mathematical sciences. I am not an expert. I'm an insurance activist, Mr. Chairman. I'm not an expert. But if anyone wishes a more in-depth or more detailed explanation, I'm happy to bring in our experts to talk about that. The second disclaimer that I will make is that this is not an accounting report. It's not an audit or an operations report. I have rounded numbers for simplicity of math. And I will say these numbers, of course, change company to company, year to year, even within Farm Bureau. But they are very fair representations of the overall property casualty market. The first item that we'll talk about today is rate making and how companies set overall rates and specifically how they go about setting them and getting them approved from the Department of Insurance. It's worth mentioning that the insurance industry is the only industry that requires government approval on both what the rate is and how the rate is set. So when we file for rate approvals, we also have to justify how we came about those rate approvals or lowering, as we'll see, does happen on occasion. No other industry is subject to that level of scrutiny, and I feel like that's important to mention. This is a general overview of the premium dollar. I'm using a dollar, obviously, for simplistic comparisons here. On average, out of every dollar that's spent in P&C insurance, property casualty insurance, 75% goes directly to pay claims. That's to roofers, body shops, fill in the blank, directly to pay claims. Companies segregate claims administration. They will also occasionally call it loss adjusting expense. On average, that can be 5%. The operating expense for insurance companies is just that, what it costs to operate the company. That's everything from buildings to land to salaries to ink pens and everything else that goes into operate that. The reserves. Another point of mention is that insurance is the only industry required by law to make a profit. We're required by law to set rates such that we make enough of a profit to put in our reserve accounts. And I also believe it's worth mentioning that the reserve accounts for insurance companies are not simply a rainy day fund or a savings account. We have very strict rules on how those reserves can be invested, how they have to be held. So a certain percentage of them have to be held in cash or cash equivalents. The point of that is to have a safely invested reserve account that can be accessible to pay future claims. And then the last item is profit. Of course, you saw the profit numbers earlier. Those do range year to year, but a fair estimate year in and year out is for companies to shoot for a 2.5% profit after all other expenses have been paid. Now, I'd like to go back and talk about the claims cost. Again, on average, 75%. We have seen, of course, that varies from year to year. But a few things to think about. As I mentioned earlier from the previous testimony, insurance is the only product that's sold where the company doesn't know what it's going to cost. Think about all of the factors. When a company sells a policy, they're looking ahead for the next 12 months, as Mr. Gordon said. Think about the difficulty in estimating how many storms are going to happen. And of those storms, how many homes will be impacted? And of those homes, how many will have a shingle blow off or a roof blow off or a total loss? How many house fires will there be? How many wrecks will there be? What will be the cost to repair those cars? You can fill in the blank on the thousands, if not tens of thousands of factors that go into estimating what a claims cost would be. At Farm Bureau Insurance of Tennessee, on average, we process 175,000 claims per year. To make that easy math, that's processing 90 claims per hour. And I'm very proud of that. The reason that I say that is that it's really important for us and for every insurance company to get it right. When companies are forward-looking on rate setting and they're estimating their future claims cost, they spend significant time and significant resources to get it right. With those numbers, and we could, of course, talk ad nauseum about that, but with those numbers, the margin of error on getting it wrong is in the tenths or hundredths of a percent. And it's very impressive on actuarial science. And Robert could probably speak in great detail about this, about how actuaries are very good in normal times about estimating what future claims would be. Let's look, for example, what happens when either a company gets it wrong or when there are unexpected things that just can't be predicted. So in this example, you see that a claims cost, again, hypothetical, has gone up from 75 to 77%. 2.5% is an extremely small margin of error. That could be one tornado. That could be a small increase in the cost of car repair, an increase in theft. Again, fill in the blank on that. But hypothetically, if that goes up with the margins of error that we're talking about in this scenario, that means there is no profit left over for the insurance company. Now, generally, profit is used for insurance company for forward decisions. And what I mean by that is that's where companies pull money from for future investment, for expansion, for new computer systems, for all of the things that will happen in the future. So a very slight increase in claims cost means there is no profit for that year under this scenario. Increase that a little bit more. Perhaps the storms are a tad bit more unexpected or a tad bit more severe than we would have guessed. Going from 75 to 80%, that means that not only does this company not make any profit, it means there's nothing to fund the reserves account. And I'll say again, this doesn't mean that an insurance company in this scenario got it wrong. It means that there could be very unpredictable things, even with all the mathematical actuarial science. It could mean that the weather patterns changed in ways that we didn't expect. Now, to take it a step further and to look at rate approval, you can see for simplicity that I am looking at this as claims cost and all other cost. Of course, we could go back to the other slide, but you take my meaning here. The concept of rate filing conceptually is very simple. We figure out what it costs to pay the bills, and in a very straightforward way, we file with the department what we anticipate our rates will be the following year. And the goal every year is to get to 100%, and that's very important. When we're calculating all costs, all in, we have to account for 100%. Now, the algorithms that companies use on calculating these can be very proprietary. Sometimes they can be straightforward. I've seen rate filings as simple as 8 pages. We've seen rate filings in excess of 14,000 pages on how they calculate these. Companies spend a lot of time and effort to get their rate approval to 100%. So let's look at a hypothetical. If the actuaries expect an estimated claims cost to increase for the following year, what does that mean? On a very straightforward basis, it means that our rate approval on the surface should go up 5%, and that's where you get a 5% rate increase. It's important to note that this is where a competitive marketplace comes into play. Tennessee, I'm really proud to say, has one of the best and most competitive marketplaces in the country. And so take, for example, a company that looks at this and says, the data indicates we should raise rates by 5%. They could do that. But what we know in the insurance industry is that insurance is one of the most shopped products on the market. When rates go up, even a percentage, people start shopping. So in the interest of competition, what often happens in this case is a company will say, well, this shows we will be 5% in the red next year. But they will make a point to the department to say, we're going to supplement that with our investment income. We expect our investment income to be 4 to 5%. And so they try to get out of a rate increase by using other funds. Or perhaps they look for ways to cut their own operating expenses, or perhaps they change some of their underwriting guidelines. The point is, just because expected increases go up because of a competitive marketplace, which doesn't happen by accident, because of that, companies look for any way possible to not increase rates. My personal opinion, and Representative Powers spoke about this earlier, some companies going up significant rates, 20, 30, 40%. Now, of course, there's lots of different scenarios on that, but my personal opinion is that some companies have gotten behind in the interest of being competitive, and now it's catching up. Inflation, interest rates, which make a significant difference, all of those things are catching up with some of those companies. Another scenario, which happens not as frequently, but it does happen, is that anticipated costs for the following year are actually lower than expected. We call this a softening of the market. Now, also in a case like this, some companies will be very quick to lower their cost and lower their rates to make themselves more competitive. We see that all the time. It could be a lowering of claims cost. It could be a lowering of operating expenses from that company. The important point to this on a rate filing point is that when a company has lower than anticipated cost or files for a lower rate, we have to justify to the Department of Insurance that even with that lower rate, that we'll be able to pay the claims and fund the reserves and pay all the bills. I'll say again, insurance companies are required by law to operate in the black. So even when we want to cut rates, we have to justify why that has to be done. The last point I'll make on rate filings and that general topic is that, as you have heard, other unpredictable circumstances come into play. This is a scenario from Farm Bureau Insurance in 2011. If you recall, in 2011, significant tornadoes came through Alabama and Middle Tennessee. Our claims cost that year was 140%. That means just to pay claims, for every dollar of premium we took in, we paid out $1.40. You can see on the graph here, all of that excess had to come from reserves. Insurance companies get criticized at times, and you've probably heard them as well, for making too much money, and I'm using that in a blasé manner, of course. Or we get criticized for having too large of reserves. Nobody criticizes a company when they're paying losses from a tornado. Nobody complains about the financial solvency of a company when they're able to pay claims even in catastrophic areas. So the first goal of a company is to provide products that are affordable. The second goal is to make sure that we're in business the following year to pay the claims, because this kind of scenario happens. And I'm really proud of how insurance companies and the entire industry works hard to find that balance, because these kind of years, when they happen, companies need to be around to pay claims. I included this next slide, which is very busy and we won't go over it. Each of these data points is a summary of thousands of other pieces of information. This is what the actuaries called load indicators. And so when we are looking forward or looking ahead at rate making, what we use for justifying rates to the Department of Insurance is, what do your indicator loads look like? Are they going up or are they going down? It's fairly simple to follow a graph at times, but I'll again point out that this is thousands and thousands of pieces of data just to get to a summary, which frankly still looks confusing to me. And that's what the actuaries use. In my last few moments, Mr. Chairman, let's talk briefly about underwriting. The rule of underwriting is that companies use the 3 Ps: property, price, and people. And we'll look at these individually. Again, this is a very simple concept, but very intricate in practice. The first P is property, and this is ignoring the price, and this is ignoring the insured. It's ignoring the person. When you look at different properties, and a company looks at different factors of property, what they're looking at is what is the likelihood of a loss for that property. Some factors can include the condition, age, dwelling type, foundation, plumbing situation, number of bathroom fixtures, roof age and type, location in relation to fire service, and others. Looking at these 2 properties, it seems rather common sense to say which would be more likely to file a claim in the event of a storm or a fire or water infiltration. And obviously, I think most people would agree that the brick ranch house looks to be, to use Robert's word, more resilient in terms of loss. So we look at property and what is the likelihood of risk from that property. Now, I want to make another point on this. I use these 2 as pretty extreme examples, but whoever lives in this dwelling in the bottom right, they need insurance too. Whoever lives in that needs insurance. Everybody needs insurance. And one of the things about a competitive market is that companies get flexible on offering insurance to various types of things. Now, the insurance would be higher relative to the value of this property, obviously, because of the risk, but there would be insurance available for this type of property because they need it as well. The second one, and also I'm using a bit of a silly example here, is price. Ignoring the drivers and ignoring anything else, these 2 vehicles, a Lamborghini and a Honda Accord, I believe, by virtue of price alone, that's going to make a significant difference in underwriting. Again, ignoring who's driving them or the risk of loss, the price alone makes a significant difference in setting that rate. And the last P is for person in underwriting. To some degree in underwriting, when we're looking at individuals, companies are agnostic on the actual dollar amounts. The goal, and you can see in this graph, the goal is to match the risk to the premium. Some factors, not limited to, of course, include ownership interest in the property, marital status, household composition, criminal record, credit history, driving history, employment status, address history, and of course, claims history. And then you add in for auto, for example, DUIs, criminal activities, those kind of things make a difference. But my point is, for underwriting individual rates, not broad rates, but individual rates, our goal is to match the individual risk profile with the individual premiums. And so you take a scenario like this, someone turns out to be a bit of a higher risk. Perhaps in underwriting, we discover that they have a history of DUIs. That doesn't mean they shouldn't be insured or can't be insured, but it means their premium is higher, that their risk profile is higher than their premium. In this situation, if we don't adjust that individual premium to match their risk, then everyone else is subsidizing the excess risk, and it goes the other way. If we discover that someone is a lower risk, it's very appropriate to lower their individual premium to match their risk profile so that they are not subsidizing others' risk. An easy example of this is a safe driving discount. Many companies offer safe driving discounts. If you go so many years and demonstrate that you are a safe driver, you often get a discount and your premium is lowered commensurate to that. I'll finish up, Mr. Chairman, by saying that in companies, when it comes to setting rates, we look at the big picture on rate filings, and we look at the individual picture for the individual. And it's a balance. We try to get it right all the time, but you'll hear complaints and we'll hear complaints. There's no way to make everybody happy when you're dealing with tens of thousands of pieces of underwriting and rate-making material. But what I am proud to say is that the insurance industry consistently finds a good balance of affordability and availability. I'm willing to bet that most of the complaints that members of this body hear are about price, not availability. Now, admittedly, for a lot of people, the price is the way to be available. But by and large, in a healthy insurance competitive marketplace, the availability is there. regardless of the risk profile. And I'm proud of how the insurance industry consistently finds that balance and continues to offer products because people need insurance, regardless of their status, regardless of their ownership, they need insurance. So, Mr. Chairman, thank you for the time. I'm happy to answer any questions. Otherwise, I'm happy to turn it back over to Representative Powers.
Oh, thank you. You have been able to create a warm feeling towards the insurance company industry. Representative Freeman, you're recognized.
Yeah, thank you. Thank you for the presentation. So I've got two separate questions, not related necessarily. The first is, what's the annual revenue for Farm Bureau?
For
Just
farm-
in Tennessee,
just in Tennessee,
Yeah.
we're close to $1 billion.
$1 billion.
Yes, sir.
And so I guess my point is 2.5% of $1 billion. I'd take that
Sure.
any day. And to act as if that profit margin is so low and to show a dollar bill, it gives the impression that it's 2.5 cents on a dollar, and when it's 2.5% on $1 billion. We have people up here who live off 3% fees. So it's not an uncommon profit margin, and that doesn't even take into account the operating expense. So I just kind of will level set what we're looking at, that the profits are there, and could they be more, could they be less? Sure, but they're there. The second one is, why do you use credit score? What does that determine on somebody's likelihood to have a wreck? Because the comment that I hear regularly is that it disproportionately affects lower income folks, or those that don't have, early in their career, don't have credit. So what's the correlation between credit score and I'm gonna text and drive and run into somebody?
Yep, sure. Happy to talk about that. About 20 years ago, the insurance industry started migrating to using, as Representative Freeman said, credit scoring. Technically, we call it insurance scoring because it's not a straight use of the credit score. It's an insurance score that your credit score does factor into. There have been, Robert, correct me if I'm wrong on this, there was a lot of attention at the federal level when this became prevalent. And if I'm not mistaken, there have been 17 government-funded studies at the federal level from government agencies, and I can get you the information on that. And all 17 showed a clear and direct correlation between a person's risk and the use of their credit score. Now, an important note that I'll make as well is that the use of credit doesn't dictate whether they are more likely to have a wreck or more likely to have a loss. It demonstrates that they are more likely to file a claim. Now, that might be a distinction without a difference, but that is a distinction I feel it's worth mentioning. I will also note that, if I may, Farm Bureau was the last company in Tennessee to start using credit scoring. We resisted that because we were using standardized underwriting practices. The reason that we started using that about 8 years ago, if I'm not mistaken, was not to increase premiums, but what we found is we were losing our best customers because they could get a lower rate elsewhere. From a company standpoint, and then I'll get back to the individual, from a company standpoint, it is net neutral. So when a company uses credit scoring, the increases that some people see are neutralized by the decreases that others see. It doesn't increase the overall revenue for the company. So companies started using it to keep their best customers, again, for what that's worth. I will also say, and I'm happy to get information to you, my professionals say that credit scoring is on its way out, that it's still part of the rate making, but as everything else in underwriting has become more sophisticated, that actually credit scoring is becoming less and less of a percentage of the overall risk profile on that.
Representative Freeman?
Mr. Chairman, if I may just add a
Sure.
couple of additional points to that. APCIA has actually done a study that we provided to regulators on credit-based insurance scores using telematics to see what the correlation is with the driving behavior. And there's a very significant correlation between credit-based insurance scores and hard braking and hard acceleration. So in other words, people who have lower scores are much more likely to engage in hard braking and hard acceleration. So it is directly tied into driving behavior as well. I also feel compelled to comment on the 2.5% profit. I mentioned in my testimony in 2022, insurance industry lost $73 billion of capital at a time when you have growing coverage needs. You try and raise new capital from the investment world when the other commercial sectors are making double-digit percentages and you're making a loss. How are you going to get the investment dollars necessary for the increased coverage? If you're making 2.5%, which is a heck of a lot better than losing $73 billion, but even at a 2.5%, you're not going to attract new investment capital to provide protection for those increased needs. That's just a factor of the free market.
Thank you. Chairman Powers, your final words?
Yeah, first of all, thank you all for having us out here today. I would mention one other thing on the credit score. The one thing that we have found out over the years, it will indicate whether or not a policy is likely to lapse or not. If people have real good credit, they'll keep their premiums paid or do automatic draft or something like that. But we run into claims from time to time where the policy's actually lapsed and then they turn in a claim, and then it causes a lot of different problems as far as trying to pay the claim once the policy is lapsed. So that was another factor that went into that. But I want to thank everybody. I mean, Ben and Robert did a great job, and I'm kind of the middleman when it comes to getting the phone calls, and then I have to try to explain what they just explained to you, to our customers, and it's not always an easy thing to do, to explain why the rates are going up if they've not had a claim and they have a good driving record. But it's just part of my job and something I've been doing for a long time. But these gentlemen are the experts in it, and I really appreciate them coming out here today and helping us out and talking to you all. And thank you, Chairman Kumar, for inviting me.
Thank you very much.
Thank you, committee.
Thank you. Thank you to all three of you for taking your time. And it was informative. Members, there being no other business, we stand adjourned.
Really good job, by the way.